where most traders see candles. I see a story of how the market builds, tricks, and then strikes. This is the candle range theory, fused with the power of three: accumulation, manipulation, and distribution. It's the blueprint of how institutions hunt liquidity and drive price, all hidden inside the anatomy of a single candle. Today, I'll pull back the curtain and show you how to read that story before it's written, and use it to be on the winning side of the move. So, what exactly is candle range theory? At first glance, it sounds complex, but the idea is actually very simple. Every single candle you see on a chart represents a range of price action. That big daily candle? It's not just a bar. It's the summary of all the chaos that happened on the lower time frames. If you zoom in, you'll see it clearly. Every candle has a high and a low, and between those 2 points, price moves in ways you can actually trade. That movement inside the candle forms a range, a little battlefield where buyers and sellers fight for control. And here's the part most traders overlook. These ranges can be swept, broken, or retested, and the exact same market behaviors we study on the macro scale also appear inside individual candles. On those lower time frames, you'll notice something fascinating. Price almost always moves in 3 distinct phases. Accumulation, where price stalls and builds up orders. Manipulation, where the market fakes a breakout, luring traders into the wrong direction. Distribution, where the real move takes place, often in the opposite direction of the fake out. This pattern repeats over and over. It's the market's heartbeat. And once you train your eyes to see candles not just as visual markers, but as mini ranges with their own accumulation, manipulation, and distribution cycles, you stop reacting and start anticipating. Because when you understand candle range theory, you're no longer just looking at candles. You're reading the story the market is trying to tell you, and you'll know the next page before it turns. Think of this as the heartbeat of the market. Price is always cycling through 3 core phases: accumulation, manipulation, and distribution, or AMD for short. Accumulation is that quiet period where price moves sideways, building up orders in a tight range. It's like the market taking a deep breath before the real move. Next comes manipulation, the sudden false breakout designed to grab liquidity and trap traders in the wrong direction. This is where the market tricks you into thinking you've spotted the move, when in reality, it's just setting you up. Finally, we have distribution, the actual move in the intended direction, often breaking away from the range created during manipulation. Now, here's where it gets interesting. You can often map these phases to the main trading sessions. Asian session accumulation, London session manipulation, New York session distribution. In other words, if the Asian session has been flat and ranging, you can usually expect the London session to run the manipulation phase, and then the New York session to deliver the true move. But here's a pro tip. If the Asian session has already expanded instead of ranging, don't expect London to manipulate. Instead, expect London to accumulate, and that shifts the pattern, meaning New York will often take on the manipulation role. It all comes down to reading what the Asian session did first. That's your roadmap. Check that before you plan your trades, and you'll have one of the most accurate ways to spot AMD and harness the power of the 3 phases. So, in case you're wondering, how exactly do these sessions work? Let's do a quick walkthrough. Open your web browser and head over to babypips.com. Once you're there, scroll down and find the Forex Market Hours tool. Click on that, and you'll see the Forex Market Time Zone Converter. Now, make sure to switch it to 24-hour time, so it's easier to read. On my screen right now, the time is about 8 p.m., and my time zone is set to Johannesburg, GMT+2. You can click on the time zone setting and adjust it so it matches your own local time. That way, all the sessions will line up for you perfectly. Now, here's how it plays out in my zone. The Asian session actually begins at around 11 p.m. South African time. But rather than overcomplicate things, let's start at 12 a.m., when the Sydney session is already open. Then at 2 a.m., the Tokyo session joins in. Remember, both Sydney and Tokyo are part of the Asian trading hours. Sydney wraps up at 8 a.m., but Tokyo keeps running until 11 a.m. Now here's where the real volatility can start. At 9 a.m., the London session opens. And for a couple of hours, London and Tokyo overlap, which can create some interesting price moves. London keeps going until 6 p.m., but at 2 p.m., the New York session opens, and we get the famous London-New York overlap, often the most liquid part of the trading day. Finally, New York closes at 11 p.m., and right on cue, the Sydney session opens again, and the whole cycle repeats. This constant rotation of sessions is the backbone of the AMD phases we talked about earlier. Knowing when each session starts and overlaps gives you a huge advantage, because you can anticipate when accumulation, manipulation, and distribution are most likely to occur, instead of guessing. Let's break down how a bullish scenario works under candlestick range theory. In its classic form, CRT on a bullish setup often refers to a 3-candle sequence on a higher time frame. Here's the basic structure. First candle, this sets up the range. Its high and low become your key reference points. Second candle, this is the liquidity grab. Price dips below the first candle's low or wicks above its high, depending on structure, sweeping liquidity before closing back inside the range. Third candle, this is the breakout candle, pushing beyond the range in the intended bullish direction. Now, here's something important to remember. CRT doesn't have to form in a neat 3-candle sequence. It can just as easily develop over a series of more than 3 candles. The core principle stays exactly the same. The market defines a range, takes liquidity, and then breaks out. The difference is in the timing. A clean 3-candle pattern typically plays out faster, while a multi-candle buildup takes longer to develop. For example, in one case you might see this sequence. First, a range candle forms. Next, an inside bar appears, staying within the range. Then, a sweeping candle dips below the range's low with its wick, clearing liquidity. Finally, price pushes back up, forming several smaller candles before eventually breaking above the range high. And this isn't just for bullish markets. The exact same logic applies in reverse for bearish setups. Just flip the highs and lows. You can use CRT principles across multiple time frames and on virtually any price action chart, whether you're analyzing Forex, indices, crypto, or commodities. Once you see how ranges, sweeps, and breakouts work together, you'll start recognizing these patterns everywhere. Now let's talk about matching your entry time frame with the CRT's time frame. This is a key step that many traders overlook, and it can make the difference between catching the move early or chasing it after it's already gone. Here's the rule of thumb. Always drop down 1 or 2 levels from the time frame where you identified your CRT when it's time to execute the trade. This lets you refine your entry, tighten your stop loss, and get a better risk-to-reward ratio. If your CRT range is spotted on the monthly chart, drop down to the daily chart for your entry. If you've identified CRT on the daily chart, use the 1-hour chart to fine-tune your trade. If your CRT comes from the 4-hour chart, your entry time frame should be the 15-minute chart. If you're spotting CRT patterns on the 1-hour chart, execute your trade on the 5-minute or even 1-minute chart for precision. And if you're working with CRT on the 15-minute chart, then the 1-minute chart is where you'll find those pinpoint entries. This top-down approach ensures you're always aligning the big picture with the fine details. The higher time frame gives you the direction and context, while the lower time frame gives you the trigger and exact execution point. By following this structure, you'll avoid one of the most common mistakes traders make, entering blindly without syncing their analysis across multiple time frames.